The day a poor farmer in rural Bihar paid for chai using his phone was the day the world's financial system quietly began to shift. No banker announced it, no global summit celebrated it, but in that small, ordinary moment, played out millions of times a day across India, something historic was happening. For nearly a century, cross-border payments and financial infrastructure belonged to a small group of Western institutions. If you wanted to send money internationally, you passed through systems controlled largely by American and European banks. Every transaction carried fees, delays, and quiet dependence on infrastructure India never controlled. Even as India's economy grew larger and stronger, its payments still moved through pipes built and owned by someone else. This dependence sat quietly in the background for decades, rarely questioned, simply accepted as the way the world worked. But in the last few years, India built something almost no one expected: a payment system so fast, so cheap, and so massive in scale that it began attracting attention far beyond its own borders. This is not a story about replacing the dollar overnight. This is a story about how India quietly built financial infrastructure so powerful that other nations started asking to borrow it. Stay till the end, because the final part of this story reveals why global financial institutions are now studying India's system more closely than ever before. It begins with a simple problem India needed to solve for itself, long before anyone thought about exporting the solution. A decade ago, most Indians did not have bank accounts, let alone access to modern digital payments. Cash ruled everyday life, and moving money meant standing in long lines, filling out paperwork, or trusting informal networks. For a country of over 1 billion people, this was not just inconvenient, it was a massive barrier to economic growth. Government planners realized that financial inclusion could not wait for slow, traditional banking expansion. So instead of copying Western banking models, India built something entirely new from the ground up. This decision to innovate rather than imitate would later prove to be one of the most important choices in the country's economic history. What started as a domestic fix for a domestic problem eventually became something the whole world wanted to understand. The system at the heart of this story is known as the Unified Payments Interface, or UPI. Launched in 2016, UPI allowed ordinary people to send and receive money instantly using nothing more than a mobile phone number or a simple code. No need for complex bank details, no waiting days for transfers to clear, no hidden fees eating into small transactions. A street vendor selling vegetables could receive payment in seconds, the same way a large company might process a business transaction. This simplicity was revolutionary, especially in a country where millions of small transactions happen every single day. Within a few short years, UPI transformed how ordinary Indians handled money, from paying rent to buying groceries to splitting a bill among friends. What made this even more remarkable was the sheer scale at which it operated, processing billions of transactions every single month. No other country in the world had built anything quite like it, especially not one covering a population this massive. But what happened next surprised even the engineers who built the system in the first place. As UPI grew, it did not simply digitize India's economy, it built the foundation for something far bigger. The system was designed to be interoperable, meaning any bank, any app, and any business could plug into the same underlying network. This openness meant that even small startups could build entirely new payment apps on top of India's public digital infrastructure. Instead of a handful of private companies controlling the flow of money, India built something closer to a shared national utility. This structure stood in sharp contrast to payment systems in other countries, where private companies often dominate and extract heavy fees. Economists began to refer to this approach as public digital infrastructure, a model few other nations had successfully built at this scale. What began as a tool for domestic convenience was quietly becoming a blueprint other nations wanted to study and replicate. As UPI's success became impossible to ignore, other nations across Asia, Africa, and the Middle East started asking a simple but powerful question: could they use India's system too? Singapore was among the first major partners, linking its own payment system directly with UPI, allowing instant transfers between the two countries. This meant an Indian worker in Singapore could send money home in seconds without the heavy fees traditional remittance services once charged. This single partnership demonstrated something the world had not fully appreciated before: that India's payment technology could work seamlessly across borders. Following Singapore, nations like the UAE, France, and several countries in Africa began exploring similar UPI integrations. Each new partnership expanded the reach of India's payment infrastructure beyond anything most observers expected when the system first launched. What started as a domestic convenience tool was steadily becoming a genuine piece of global financial infrastructure. This growth mattered enormously for a very specific reason: the enormous cost of traditional cross-border remittances. For decades, migrant workers sending money home lost significant portions of their earnings to fees charged by traditional money transfer companies. A worker earning modest wages abroad might lose 10% or more just to send money back to their family. India, home to one of the largest populations of overseas workers in the world, felt this pain acutely for generations. UPI's cross-border expansion offered a genuine alternative, cutting fees dramatically and speeding up transfers that once took days. This was not just a technical improvement, it was a direct financial lifeline for millions of families depending on remittances to survive. Governments in partner nations recognized this benefit immediately, seeing reduced fees as a direct boost to their own citizens' financial well-being. What seemed like a purely domestic Indian success story was quietly becoming a tool improving lives well beyond India's borders. Meanwhile, a much larger conversation was unfolding in the background, one connected to the global dominance of the American dollar. For decades, the dollar served as the backbone of nearly every international transaction, whether trade, remittances, or reserve holdings. This dominance gave the United States enormous influence over global finance, including the ability to enforce sanctions through banking systems. As geopolitical tensions rose in various parts of the world, more countries began quietly searching for alternatives to dollar-dependent infrastructure. India's payment system, built independently and controlled domestically, suddenly looked appealing to nations wary of relying entirely on Western-controlled financial networks. This did not mean countries were abandoning the dollar altogether, but it did mean they were diversifying their options carefully. India offered something valuable in this moment, a proven, functioning alternative that did not require political alignment with any single global power. This positioning gave India quiet leverage in conversations about the future of global financial infrastructure. As this story developed, India began exporting more than just its payment technology. It began exporting the underlying philosophy behind it. Countries in Africa and Southeast Asia, many still building their own digital financial infrastructure, saw India's model as a realistic template to follow. Rather than depending entirely on expensive private financial systems built by foreign corporations, these nations could build their own public digital infrastructure instead. India began actively sharing knowledge, technical expertise, and even direct technological support with nations interested in building similar systems. This shift mattered enormously for developing economies that previously had few affordable options for modernizing their financial systems. For many of these nations, India represented a rare example of a developing country successfully leapfrogging older financial infrastructure entirely. What one nation built to solve its own problems was becoming a genuine development model for much of the global South. At international forums like the G20, which India hosted in 2023, this digital payment story took center stage. Indian officials presented UPI not just as a national achievement, but as a potential global public good available for other nations to adopt.
World leaders who once viewed India primarily as a large but developing market began viewing it as a genuine technological innovator. This shift in perception mattered deeply, changing conversations in rooms where global financial policy gets shaped and debated.
Financial institutions that once dismissed Indian fintech innovation as a purely domestic story started building dedicated teams to study its international implications. This was no longer a story confined to business journals covering emerging markets. It was becoming a mainstream conversation in global finance. What happened next surprised even those who had been closely following India's digital payment journey from the very beginning. International financial institutions like the International Monetary Fund began publicly acknowledging India's payment system as a model worth studying. Reports and case studies highlighted how India managed to build affordable, scalable digital infrastructure without relying entirely on expensive private sector solutions. This recognition carried significant weight, coming from institutions long associated with promoting traditional, Western-dominated financial models. For India, this was more than validation. It was proof that its approach to financial infrastructure could influence global policy conversations. Other developing nations, watching these discussions closely, began pushing their own governments to explore similar public digital infrastructure models. This ripple effect meant India's influence was spreading not just through direct partnerships, but through the ideas and models it demonstrated as possible. A system built to help a farmer pay for chai was now shaping serious policy discussions inside major global institutions. But perhaps the most significant development came through India's growing role in trade settlement discussions connected to this payment infrastructure. As India expanded rupee-based trade agreements with various partner nations, its payment systems provided the technical backbone making these arrangements practical. Digital infrastructure and currency strategy began working together, reinforcing each other in ways few observers initially anticipated. Countries exploring rupee trade settlement found that India's payment technology made these arrangements far easier to implement in practice. This connection between currency strategy and payment infrastructure gave India a unique advantage most other nations pursuing similar goals simply did not possess. It was not enough to talk about alternative currency arrangements. Someone needed the actual technical systems to make them work smoothly. India, almost by accident, had built exactly that kind of system years before anyone realized how strategically valuable it would become. This is where the real shock begins to settle in for global financial observers studying this trend closely. India was never trying to directly replace the dollar as the world's dominant reserve currency, and officials never claimed otherwise. The goal was always more practical, building efficient, affordable, sovereign financial infrastructure that served India's own economic interests first. But in solving its own problem, India inadvertently built something the rest of the world increasingly wanted access to as well. This is fundamentally different from a nation trying to aggressively challenge existing global financial power structures through confrontation or political coercion. Instead, India built something so genuinely useful that other nations voluntarily chose to connect with it, expanding its influence organically over time. This organic growth carries far more long-term power than any system imposed through political pressure or economic coercion ever could. Systems that spread because they work tend to last far longer than those spread through force or obligation. As more nations connect their systems to India's payment infrastructure, a quiet network effect begins to take shape. Each new partnership makes the overall system more valuable, more resilient, and more attractive to the next potential partner nation. This is precisely how dominant global systems have historically been built, not through single dramatic announcements, but through steady, compounding adoption. The dollar itself became globally dominant partly through this same kind of network effect, reinforced over decades by trade, trust, and habit. India's payment infrastructure is still far smaller in global scale, but the pattern of growth looks strikingly similar in its early stages. Financial historians studying these trends note that dominant systems rarely announce themselves loudly at the very beginning of their rise. They grow quietly, gain trust gradually, and eventually reach a point where ignoring them becomes more costly than adopting them.
This pattern worries some Western financial institutions more than they publicly admit in official statements or press conferences. A payment system controlled by India rather than by Western financial institutions represents a genuine shift in who controls critical financial infrastructure. For decades, control over payment rails meant significant geopolitical leverage, including the ability to enforce sanctions or monitor financial flows. If more nations route their transactions through systems India controls, that leverage naturally shifts, even if only gradually and partially. This does not mean India seeks to challenge Western financial power directly, but the practical effect moves in that general direction regardless of intention. Policy analysts in Washington and Brussels have begun quietly studying these developments, aware that ignoring them could prove costly in the years ahead. What started as a domestic Indian solution to financial inclusion has become a genuine topic of geopolitical significance. So why does all of this really matter for the future of global finance? For nearly a century, the world assumed that critical financial infrastructure would always be built, owned, and controlled by a small handful of wealthy Western nations. Developing countries were expected to adopt these systems, pay their fees, and accept the terms set by institutions they had little influence over. India's rise as a builder of global financial infrastructure quietly challenges this old assumption in ways still unfolding today. This transformation did not happen through confrontation, aggressive policy, or attempts to forcefully displace existing global financial systems. It happened because India solved a massive domestic problem so effectively that the solution became valuable far beyond its own borders. Farmer by farmer, transaction by transaction, partnership by partnership, India built financial infrastructure that the world increasingly wants to be part of. The world underestimated how significant a domestic Indian technology project could eventually become on the global financial stage. Today, India's payment system is no longer just a story about financial inclusion within its own borders. It has become a genuine case study in how nations outside the traditional Western financial core can build lasting global influence. This did not happen overnight, and it did not happen through luck or accident. It happened because India built something useful first and let its value speak for itself across borders, one partnership at a time. And as more nations continue watching this model succeed, the question is no longer whether India's financial infrastructure will matter globally. The question is how large a role it will eventually play in shaping the next chapter of global finance. India didn't set out to replace the dollar or challenge the world's existing financial order through confrontation. India simply built a better system for its own people first. One transaction, one partnership, one quiet breakthrough at a time. And that, more than any dramatic declaration ever could, is why the world can no longer ignore India's growing influence over global finance.